Throughout my career, I've seen stock buybacks happen. You hear about it on the news, but it took me years to take the time to actually understand it.
Well, I'm glad you did, because without understanding how they impact a company's financials or its outlook, you really can't understand how it could impact you as an employee or an investor.
Yeah, you're so right. So stick with us because we're about to break down everything you need to know about stock buybacks, what they are, the pros and cons, and who the biggest stock buybackers are. By stock backers, I don't know. Stay tuned. Hey, this is Stephanie, tech veteran, engineer, and creator.
And I'm Bertrand, founder of App Economy Insights.
All right, first things first. What exactly is a stock buyback or share repurchase? It's when a company decides to use its cash reserves to buy back its own shares from the marketplace. There are a few reasons why a company would do this. The first being to return money to shareholders that it doesn't need to fund operations or other investments. And we'll explain how this works in a second.
Just know that they do this because one of corporate America's highest goals is to maximize shareholder value. According to this principle, a company should always aim to generate the highest possible returns for its investors. Increasing the value of its stock and returning cash to holders in the form of dividends or stock buybacks is how companies maximize value for shareholders.
You gotta love capitalism. All right, so how do stock buybacks actually work? Well, a company can buy back its shares from the open market or directly from investors. When a company repurchases its shares, the number of outstanding shares is reduced. Many investors believe that this reduction in shares will drive up the share price. And of course, this assumes that the demand for the shares will not be affected by the buyback. And if you're curious about how much a company has spent on share repurchases, you can find that information in the quarterly earnings reports. Head over to the cash flow statement and look under financing activities.
So let's break down all the reasons why a company would do a stock buyback. We mentioned maximizing shareholder value. So how? When a company buys back shares, it can actually make each shareholder's annual dividend sweeter. Imagine you're splitting a pizza with your buddies. If you reduce the number of slices, everyone gets a bigger piece, right? Same goes for dividends. Plus, if the company's earnings and total dividend payout keep growing, reducing the number of shares can make the dividend growth even sweeter.
Another reason, tax efficiency for shareholders. You see, when a company pays out dividends to its shareholders, those payments are considered taxable income, reducing the overall amount that you get to keep. But during a stock buyback, you can choose not to sell your shares. As the number of outstanding shares decreases, each remaining share becomes more valuable. If the stock price increases, your overall investment value goes up without triggering any immediate tax liabilities.
Another reason for stock buybacks is the company might believe that their shares are undervalued, so buying them back can be a good investment. In 2022, as we faced a bear market, many management teams increased their share repurchase programs and bought more than usual. It's like when you spot a bargain at your favorite store and you just can't resist. When a company does this, they are sending a message to the market. It's a bit like saying, hey, we believe in ourselves and we gotta show the world that we're worth it.
They might also want to offset dilution, and this might impact us tech workers the most. Growing companies may find themselves in a race to attract talent. If they rely on stock-based compensation to attract and retain employees, it increases the company's total number of outstanding shares and dilute existing shareholders. Buybacks are one way to offset this effect. It's simple. Stock-based compensation increases the share count and stock buybacks lower the share count. To learn more about stock-based compensation, we got you covered with a dedicated video on our channel.
Now, let's talk about how stock buybacks impact a company's financial statements. When a company repurchases shares, it uses its available cash, which is reflected as a reduction on the balance sheet. So you'll see a decrease in the company's cash position. At the same time, the repurchase reduces shareholders' equity by the same amount on the liability side of the balance sheet. You can find the stock buybacks for a specific period in the cash flow statement under the cash outflows from financing activities. As you can see, Apple here returned most of its cash generated in FY22 to shareholders via stock buybacks.
All right, let's talk about its impact on the company's valuation. Once a company goes ahead and buys back its own shares, there are a couple of things that can happen. First off, they can choose to cancel those shares, which means the total number of shares outstanding permanently decreases. Alternatively, they can hold onto those shares as treasury shares. These treasury shares are not included when we count the shares outstanding. Think of treasury shares as stocks that a company keeps in its own treasury or reserve.
This matters when it comes to earnings per share, or EPS for short. It's calculated by taking a company's net profit and dividing it by the number of shares outstanding. But if you reduce the number of shares outstanding through a buyback, you're actually giving the company a higher EPS. It's like leveling up their financial performance.
And when it comes to price to earnings ratio, or PE ratio, this helps investors find out how a company is valued compared to its earnings. We calculate it by dividing the stock price by the EPS. So when a company reduces its shares outstanding, the EPS gets higher, which means the PE ratio could decrease, making the company's stock price look more attractive to investors or undervalued compared to its earnings potential. It's like getting a discount.
Of course, there are pros and cons to stock buybacks. So let's start with the perks. First off, it's like a confidence boost for the company. By buying back its own shares, the company is shouting from the rooftops, "We believe in ourselves!" So much so we are investing in ourselves. It's like a powerful statement to investors that they are not messing around.
Of course, there are a few downsides to consider. Okay, picture this. You go shopping for new clothes when you're feeling flush with cash, and you buy a fancy outfit. But then the next day you find out that there's a massive sale and the price of that outfit drops. So pretty bad timing, right? Well, the same thing can happen with stock buybacks. Sometimes companies buy back shares when the stock price is sky high, only to see it drop later.
Now, here's another thing to think about. When a company repurchases shares, some people might wonder, hey, does that mean that they've run out of exciting growth opportunities? It's like when you've finished all the levels in your favorite video game and start playing them again anyway. Investors who are hungry for growth might see this as a sign that the company is running out of fresh ideas.
Wait, does that mean that you've actually replayed entire video games again?
Well, I mean, only once with the first Dark Souls, on PlayStation 3, maybe twice.
All right, well, it could also be a poor use of cash. Depending on many factors, stock buybacks may privilege short-term gains in share price when other more profitable uses of cash are available. Investing in research and development or simply stockpiling cash for a rainy day may not help share prices, but they could offer better value over the long term. If they use up all their cash on stock buybacks and then face tough times or unforeseen expenses, they might find themselves in a tricky situation.
Next, debt-fueled share buybacks. In the years before the pandemic upset the economy, up to half of all buybacks were financed by taking out debt. Low interest rates incentivize companies to borrow money to spend on stock buybacks to benefit stock prices in the short term. Many critics suggest this was a short-sighted strategy and dangerous to the economy.
Cash-rich companies tend to have high stock prices. Some companies launching stock buybacks have built up a war chest of cash after a period of good performance, and they usually have high share valuations, meaning they may be producing less value for shareholders than other uses of cash.
Many public companies issue compensation to managers in the form of stock, which dilutes other shareholders. A company might do buybacks to obscure how this form of compensation impacts the company's share count. It's like draining a swimming pool, buying back stock, and filling it up at the same time with a hose, creating new stock through options.
Despite these downsides, stock buybacks are pretty common because they can boost EPS. In fact, since 2018, they've increased by 25% in the S&P 500. And to no surprise, Apple takes the cake for doing the biggest stock buyback in 2022. That's $90 billion for 3.5% of shares. Since 2012, they spent a staggering $467 billion on buying back their own stock. And they even hold the record for being the top repurchaser among all companies in the S&P 500. Why have stock buybacks been pretty concentrated in tech companies, you might ask? They're the companies that have the largest cash flows, which enables them to buy back stock.
Okay, so what does this mean for you. If you invest in individual stocks and are wondering if a stock buyback is good news or not, think about it this way. If a public company is doing well, has cash to spare, and its shares are undervalued, then a buyback could be a positive for shareholders. It returns cash to you with no tax implications.
But if a company is repurchasing shares of stock while it ignores other parts of the business or holds back on investing in its future growth, it's a decision that will likely cost shareholder value in the future.
If a company's shares are overvalued, shareholders like you would be better served by the company hanging on to the cash for a rainy day.
Stock buybacks are just one part of understanding a company's performance. The best thing that you can do is to understand the full picture by looking at financial statements. And we have a whole video series, so we'll see you there right now.